So I got some local IPA right here. Anybody else?
I have some from Maui Brewing Company.
I'm contra the herd here. I got a red wine.
Classy.
It's early for me.
All right. Well, it's great to have you all today. So many of the experts in the precious metal space on one call together. And what I'd like to talk about today is this last quarter was very unexpected for a lot of people. We saw precious metals fall, gold fall more than silver. And, this wasn't necessarily what we were expecting with, all the money printing we've seen and we saw last year. We were expecting precious metals to rise. So I wanted to turn it now to Andy, and I'll ask a question to Andy. But first, if my brother Kaiser, who's on the line, the co-host for Mugs and Metals, can introduce Andy, our president of Miles Franklin.
Andy Schectman is president and owner of Miles Franklin, a precious metals company that has eclipsed $5 billion in sales. Prior to starting Miles Franklin, in 1989, Andy became a licensed financial planner, specializing in Swiss franc investments and alternative investments.
Andy, in your perspective, why have we seen precious metals fall this quarter? It's not what a lot of people were expecting. They were thinking that precious metals would rise.
It's the commercial banks that's selling. I think you don't have to go any further than what we saw the first 2 days of February. And I've talked about this a lot, but, it bears repeating, because when you look at what was going on the first few days of February, the demand was unlike anything any of us have ever seen, ever, at least me in 30 years. We had more phone calls on February 2nd than we ever have in a single day. I was on a vacation in Florida. I had a 10-day vacation at an Airbnb on the ocean in Florida, and I never walked out of my house. I worked 18 hours a day in a room while my family was outside at the beach. I could not leave the house for even 60 seconds, literally, and I'm not joking. The demand was so much that we saw record volume going into the ETFs. We saw all the online companies shut down that Friday night. Because they were, in essence, staring into the abyss with massive demand as the market closed. And they weren't able really to properly hedge their business over the weekend. When the market closes on Friday night, we'll use Central Time as an example, at 5 p.m. or 4:30 p.m., it sleeps until Sunday night at 5 p.m. That's the only time that it's not really open throughout the week. And when that happens, typically we'll buy an exposure with COMEX contracts into the close on Friday so that we can sell product over the weekend that is hedged. That particular Friday, my head trader thought that 55,000 ounces of silver would be enough till Sunday night. Late Friday evening, I noticed that JM Bullion and SD Bullion and APMEX, they'd all shut down. Now, it appeared from an outward perspective that maybe they were all out of product, because it said out of stock, notify me. But really, while that may have been partially true, the reason is what I was saying, that they weren't able to hedge the amount of business that they were potentially going to do over the weekend. So they just shut it down. Saturday morning, I get a call from my head trader. He says, do you realize we sold 90,000 ounces since last night? You're 35,000 ounces naked exposed to the open. I said, shut it down. First time in 31 years, due to demand, I had to actually shut down over a weekend. When the market opened up, it gapped up just a little bit. People were talking about it going up $10, went up just over $1, cost us $42,000. The point of what I'm getting at here is that at this point, record demand into the ETFs, record demand with the Reddit group, record demand shutting down all of the online companies, all of us doing more business that week than any of us had ever done in months before. And so in that environment, one would suspect that the worst thing you could possibly do is what happened that next morning. We're heading into New York Open right after London closed in that access market. Someone dumped 1.5 billion ounces of silver at the Open. That's almost 2 years worth of global mine supply. And at $30 an ounce silver, you're talking $45 billion of paper silver was dumped onto the market to create an effect, to scare all of the Johnny-come-latelys and the Reddit people off their trade. And in real life, that person should have been fired and maybe even prosecuted. In that environment, there is not a professional trader on the planet that would dump $45 billion, worth of paper silver onto the market at the open all at once instead of bleeding it out over a period of time to maximize return. And what it did is it dropped the price of silver by almost $4 instantly. From that point forward, it has been a battle, I guess you could say, between the physical demand and the paper price, where the physical demand is disconnected from the paper price. I will tell you that everywhere I look, whether you look at the Perth Mint, whether you hear what's going on at the Royal UK Mint, whether you talk about the rumors swirling at Kitco, whether you talk about record demand into the ETFs, everything that we're seeing as a precious metals company, I'll put it to you this way. We've done $125 million in sales in the first 3 months. That's a year's worth of business. I will tell you that the price is nowhere near reflective of the demand. And so why hasn't it gone up? Well, I guess I would just basically say I believe that it is selling by the commercial banks in a concerted effort to keep the price from skyrocketing. And it's getting much harder for them to do that. They have to expend more energy to get less results. And it really, because of a lot of people like you guys who are out there, Craig, you do an amazing job of talking about this. And the truth is getting out there. People are waking up to it. What John Adams is talking about is having a massive effect on people moving from unallocated to allocated. And all of these things cumulatively are what I would call an awakening. Now, the question is, are they able to continue to hold the price down? But simply, I will tell you this: the level of demand right now is nowhere near indicative of the price. The price should be markedly higher. And I guess if you simply just look at the price of a 1 ounce silver coin, you can't buy a 1 ounce round or a 1 ounce silver coin right now for under $30 anywhere in North America. So a paper price of 25 is really malarkey. It's just not real when you have to spend at least 30 to buy an ounce of silver. So, and I guess the same thing is true with gold. And I guess I'd just like to just hold the floor for one extra second. When we see the amount of deliveries that are happening right now in gold and silver, record amount coming off the Shanghai Gold Exchange, 90 million ounces backdoored out of SLV, 55 million ounces taken off of COMEX, 30-some million on exchange for physical, all in silver. The first couple of days of the April futures gold contract saw 2 million ounces of gold delivered. The big money is taking money off of, or taking delivery of it off of the exchanges. And then in March, we saw 35 million actually leave the building. So maybe that's Elon Musk, maybe that's Panasonic or Sony. Or the thing of it is this, is that I think people are waking up. And one of the things that I couldn't understand last year with all the deliveries that we saw is why no one was taking possession. And to see 35 million ounces leave the building, to see all the gold taken off the Shanghai Gold Exchange this last month, you're beginning to see the big money, I think, realize what we've been talking about and front run taking delivery and getting it out of harm's way. So why hasn't the price risen, Elijah? It's because it's being held back for the same way that it has been for a very long time. I guess my hope, however, is that an awakening, a real awakening, an expansion into a greater swath of interest, I think will change that. And I'm very hopeful that it will. So hopefully when we have one of these again in the next month or two, we'll look back at it and say, geez, this last run here, right after the inflation numbers came out, was the beginning of the next phase in this bull market. So I think the moral of the story is to realize that price has been used as a tool of misdirection, and it is not indicative of demand. So I'd like to listen to what these gentlemen have to say to answer that question. But I, for one, believe the price should be markedly higher from where it is right now.
And on that note, I really wanted to ask Gary a question with respect to all of this. But first, if my brother Kaiser can introduce Gary.
Gary S. Wagner is the executive producer of The Gold Forecast. He's been a technical market analyst for 35 years and is a regular technical analyst for The Street TV and Kitco News. He's a frequent contributor to Stocks and Commodities magazine and has also written for Futures magazine and Barron's.
It's great to be here. I differentiate myself in that my background is in trading futures. paper assets, so to speak. And you're absolutely correct. There's a huge disparity between physical holdings and the absence of a lot of ability to fulfill those orders and the paper trail or paper money. As far as gold and silver through the futures exchange and the ETFs, I believe that one of the reasons we have seen price declines when I would expect them to go up is that according to liquidity theory, we're going to put our money wherever we see the best results. And the country is opening back up. There's no doubt about it. There's still hot spots, but the economies are beginning to open back up. And as such, I think that there is an over-optimism in terms of U.S. equities. And that's been pulling money from the safe haven asset class into the risk on. The other thing is the cryptocurrencies. Bitcoin hit, 63,000 today? So the speculative money is moving away from that. And that is kind of my take on that. The CPI numbers came out. They are showing that inflation is hotter than expected. And I would look at that as a precursor to a more dynamic move to the upside.
Now, with respect to the pullback that we are seeing, I wanted to get Kai's perspective on this.
Kai Hoffmann is the founder and managing director of SOAR Financial, an international corporate communications firm focused on the junior mining industry. Kai has over 10 years' experience as a consultant in the capital markets. He is also CEO of Vancouver-based data mining company Orin Inc.
Now, Kai, as we're seeing this pullback in the metals, do you see the mining sector being negatively impacted from it? What is your take?
It's interesting. I loved hearing, listening to Gary and Andy as well, because it sort of fits the narrative overall. Because sentiment is very mute right now in the gold and silver space, or a precious metals sector, right? Every $10 up for a gold price is being celebrated hugely. Every $20 down means the next crash. Like we looked at the CPI numbers this morning, and gold rose up, but it didn't break through any technical levels. So we're still in the same range between 1680 and 1750. Nothing's happened. Nothing's changed. And actually, like my Twitter echo chamber seems to resemble that, because there wasn't any euphoria today. Right. So I can't really pinpoint it, but it's mute out there. We need to break some interesting resistance levels. And if it has to do with the physical side, which is really interesting, Gary mentioned Bitcoin. There's a lot of competition. Cheap and free money makes it so easy to invest in the S&P 500, a market I really don't follow too closely, but just it's been marking, like, 6 highs in 7 trading days. It's ridiculous. Like, you can't compete with that as an old, precious metal. It's just too boring. All right, a 1.5% here and there, like that's what the S&P does every single day. That's not of interest. So we need a spark of interest, and I've been saying that for a couple of years now. But we need to scare the 401k money out of the main markets for a little bit, and that would help our sentiment.
Now, with respect to the sentiment, if we can now turn our focus to Craig Hemke from the TF Metals Report, Kaiser, if you could introduce Craig.
Craig Hemke began his career in financial services in 1990, but retired in 2008 to focus on family and entrepreneurial opportunities. Since 2010, he has been the editor and publisher of the TF Metals Report, found at tfmetalsreport.com, an online community for precious metal investors.
Now, Craig, I know that you were recently on a podcast and you were talking about how you think that silver has found support right now. So as we've seen precious metals pull back, kind of getting your perspective on this. First, why have precious metals pulled back, and where do you think they are headed in the near future?
Well, I think I can wrap this up with some good news. I want to first concur with Andy, of course. I wouldn't even have a precious metals website if I didn't recognize that they were ultimately, manipulated and managed for profit by the bank trading desk. And all that's been proven out to be true. It used to be, crazy talk to even discuss such things, but not anymore. So that's a big part of why the downtrend maybe has lasted longer than what everybody thought. But where we've got some good news is what happened today with the CPI numbers, and more importantly, the bond market reaction to the CPI numbers, because the fundamental reason why precious metals, specifically gold, have pulled back for 7 months is because real interest rates have been rising. And what I mean by real interest rates, that's your inflation adjusted returns on your treasury notes, your 10-year treasury notes specifically is what people look at. And if you go, there's a very strong, about 95% inverse correlation between gold prices and real interest rates over time. You go back to last summer when gold was nearing $2,100, The inflation rate as measured by the CPI was 1.6%, but the 10-year Treasury note was only yielding 0.6%. So your real inflation just return was negative 1%. That's very bullish. It always has been for precious metals, and that was what was underlying that rally last summer. Well, in the time since, up until this most recent CPI report, all we've seen is nominal interest rates go up, all the way up to 175 on that 10-year. And the reason why we've kept going down all through this first quarter is the 10-year note's gone from 1% to 175 just since 1st of February. So this has been a problem, and real interest rates have actually turned positive. And we got all the way down, like I said, 1680, 1700 in gold. Well, now, here's the thing. 3 weeks ago at the end of the FOMC in March, Chairman Powell pointed out something I hadn't really even thought of, and that's your annualized CPI is your rolling 12-month average. Add them all together. And March and April of 2020 was a period of deflation as we were locking down and shutting down and everything else. So as March 2020 comes off of the calculation and you add in March 2021, you were going to get a spike in the annualized CPI. That's exactly what we got today. We're up to 2.6. And that's going to continue. April's going to come off next month, and you'll probably go up maybe even closer to 3%. Well, here's the thing. Now that we're 2.6 on the CPI, and with the bond market rallying today back to 1.6 on the 10-year note, well, now we're -1 again. It's exactly where we were when gold was $350 higher. I think the market kind of figured that out today. That was a big part of why we rallied. And I think what we'll see going forward now is a continual, I guess, slow grind higher that will tick off maybe some trip wires, if you want to call it that, of moving averages and trend lines that'll get people more and more excited in the weeks to come, provided the bond market doesn't sell off. If the bond market goes to 2%, all of this is nullified. But if we stay here and even rally like we did today, 1.6, and we establish this -1% or even lower real interest rates, that's going to be very supportive going forward. So I think that's what has fundamentally been driving prices lower and driven it lower than we thought they'd go over 7 months. But I think there's reason for optimism here, again, provided that the bond market doesn't just now go in a whole nother round of selling off and we go to 2% in the 10-year. So Elijah, now to your question about silver, the fundamentals are obviously fantastic, as Andy pointed out. That's the bifurcation of the market, though, in that the price that's discussed on CNBC or Bloomberg is the price of the derivative. And how's that determined? Well, by supply and demand of the derivative, right? And whether that's actually connected to physical metal, I guess that's a topic for another day. So you get this bifurcation. It won't last because it's a threat to the pricing system itself. If you've got physical silver at 40 and a paper price at 20, people throw up their hands and go, what the hell's going on here? And that's what happened in March of 2020. We eventually met in the middle. And that's probably where we're heading again. If we get strength in gold and these underlying fundamentals, that's going to help as well. And there'll be some key levels to watch going forward, but it's certainly encouraging to see silver back over its 200-day moving average and hopefully now starting to move higher again.
Thanks, Craig. I know Elijah's got a question for Jerry. Jerry Robinson is an economist, veteran trend trader, and trendsetter probably too. Best-selling author, investor, public speaker, trading coach, and founder of followthemoney.com. Jerry also has a passion for researching and teaching the Bible. Jerry's best-selling book, Bankruptcy of Our Nation, provides an eye-opening critique of America's debt-based economic system.
We just heard from Craig that, he talked about the CPI, right? Today just being released, that it's the highest inflation we've seen in 2.5 years. And you've talked about in your book, Bankruptcy of Our Nation, how the dollar, is not necessarily going to be the top dog forever. And you've been talking about on your radio show about how the Chinese just released, a digital yuan, and that could be a threat to the petrodollar. So what is your perspective on the dollar going forward as we see inflation rising? And also, how is that going to impact precious metal markets?
Thank you, Elijah. Thank you, Kaiser. And thank you, Andy, for having me on. It's an honor to be here. I enjoy these. And I thank you for the very nice mug, by the way. The the dollar is a challenge. When you look at it on a chart, it was pretty clear that the volatility in 2020 was going to resolve somehow, and it began to unwind. And if you look at a longer term chart of the U.S. dollar, I'm a chartist and I use technical analysis largely. And when you look at a long-term chart of the U.S. dollar, of course, you see a general long-term downtrend. When you go out macro, go back to say, maybe even the beginning of the 20th century, you see a total annihilation of, purchasing power for the U.S. dollar. But now when you get into the minutia of day-to-day changes, of course, it becomes a bit more difficult. So when we look at, say, for example, the U.S. dollar right now, we see it flirting with its 200-day moving average. We just saw the very first breakout above the 200-day moving average on the dollar for the first time in months, largely due to, as I think it was Craig who had pointed out, the rising interest rates. I mean, this, of course, is putting a tailwind on the U.S. dollar, and that, of course, hurts commodity prices, although some commodity prices haven't been affected. I mean, lumber doesn't seem to care. It's just going straight up. There are many other, uranium has actually done pretty well, even though it's very early in the cycle. It's really showing some trend strength in the near term. So those are examples of things, that are bucking that somewhat of a rising dollar we've had in recent weeks. But we just saw the U.S. dollar now fall through that 200-day moving average along with rates. So again, the minutia of the U.S. dollar, difficult to say where it is here. What we do know is that countries like China and others are eager to get outside of the U.S. dollar system, and they're creating ways to do it. The AIIB, of course, this new digital currency that China has released, the digital yuan, it's outside of the U.S. financial system. This gives them the ability, Elijah, to sidestep sanctions. It gives them the ability to sidestep the heavy hand of the United States dollar supremacy that is wielded so freely by the United States. And so, is the United States dollar in jeopardy now of going away? No. And we've always said it was never going to be a fall off of a cliff. It's a long, steady grind down the hill where you hit every rock and pebble along the way. It's much worse than just falling off the cliff. It's a long, slow, humiliating grind. Now, just briefly, if I can just comment real briefly on gold and silver, I'm along both gold and silver physically. I like hard assets. We keep 5% allocated to digital assets like Bitcoin, and we keep 15% allocated to the commodities market generally, with gold and silver being a component of that. And we hold it as insurance, against reckless monetary and fiscal policy. Well, just the final comment I want to make here is that when you look at a price of gold, the key moving average we look at, technically speaking, is the 250-day moving average. That area held all the way from the very beginning of 2019, when we called the new uptrend, until it broke down just back in February, whenever things started breaking down. Until we retake the 250-day moving average, we wouldn't expect, much momentum here for gold. And then finally on silver has been really, if you take a look at a chart going all the way back for many months, you'll see that the 100-day moving average has really been the area where it's been grinding along. That is of course, the first thing that it has to take out. But then $30 resistance overall, until we're talking real move here, we have to break out above that $30 level. It's been an overhang for some time. And when we break out above it, no doubt, silver prices could really zoom, but that's pretty big overhead resistance in the near term.
Well, speaking of charting and resistance and that kind of thing, we've got Patrick Karim. He's a chart trader and gold and silver aficionado. He takes a unique approach to charting and technical analysis on badcharts.com.
Hi, guys.
Patrick, if we could get your perspective on all of this, what Jerry is saying, because I know we've had you on the show before, and really that key level, that 30 level, is a really important level for silver. Can you give us an update on that? Where do we stand today, and what does it look like going forward?
I always try to take a step back, and silver, it's still on track. The explosion it had off those March lows, and then after that it went all the way to 29, hit that what I call a wall. So that's that top pattern from 2011 to 13 when it broke down. That support now became resistance. So yeah, now we're trying to hit it a few times. We're kind of creating like could call it a flag or a consolidation right below. But once that resolves, the measured move is that low from March and then added on top. So like Jerry said, once we bust through that and we have a monthly close above 29 or 30, it's just going to be a vacuum. And if you want any like fractals, like just look at gold. Gold did exactly the same thing about a year before. Gold hit its wall, like that breakdown level below 2013 when it broke down. And when they hit it, it consolidated a little bit below it. And after that, when it busted above, it just went all the way to 2000, wherever it landed. So always look at, like, I look at fractals, gold and silver, they follow suit. And my biggest tell for me for silver that we're going to hit all-time highs, and it's whenever gold hit all-time highs, silver never failed to do it, never. So it took, usually I measured a few times since the 1960s or 50s. It takes around like 5 months to maybe 40 months, but that was a worst case scenario where silver had to go through the GFC drawdown before trying to get back above those all-time highs, but it never failed to do so. Gold leads the way, because a lot of people, they look at the commodities, oh, gold's lagging. No, gold was the first one to break out. It led the path for all of us, all the mayhem. Look, I became a crazy gold bug when I saw gold breaking out against the Canadian dollar, the Australian dollar, way before it did before the US dollar. I said, what the hell's happening here? Man, I have a crystal ball. I'm going to be a millionaire. But gold led the way. So when it broke out in July or June of 2019, that was just a question of time. All the building blocks, everything's moving along. And I took a look at the macros, what's really like important for gold, and it's not absolute numbers of interest rates or money supply, it's the rate of change. And the market needs time to digest that. In the 1940s, when they had a huge rate of change in the deficit, after that generated an explosion in silver that lasted for like 30 years after that, all the way to the 1980s. And we just had the same type of explosion. So the deficit never distanced itself from its moving average that fast. So guys who are like, the retail guys who are too close to their screen and every day, how come a silver is not going over 30? They're missing the big picture. Under leverage, hold back, you're going to have a crazy wave. Like, this is the buy and hold of your lifetime now. Real assets, hard assets, M2 money supply that exploded crazy. Nothing's priced in yet, nothing. So you got to really take a step back, position yourself right now. Like right now, $25 silver for me is pretty much like its lows right now. Like on a monthly basis, I doubt we're ever going to close below that unless maybe there's like a GFC type event. But this, man, it's crazy. Sometimes I pinch myself like, this is like an opportunity of a lifetime. And the more I dig, like I'm not a fundamental guy like you guys, but like the charts are screaming that the cycle has just started, and maybe something in 2024 is going to happen where we're going to have a drawdown, but that's nothing. Hold on and just keep some powder and add whenever there's a crash, and then we're going to skyrocket. Because what we see in expansion right now in M2 and the deficit is nothing compared to the next market crash. So either we're like in 1995 where the NASDAQ is going to go up another 4 years, or we're in 2001 and it's going to crash. But either case, the metals and commodities are just going to explode. So yeah, that 30 for me is just noise. Every time we bounce down, just buy some more, get your favorite miners, do whatever you have to do, man, because in 5 years, you're going to say 25, how come I didn't load up more? You know, it's just crazy right now. So that's pretty much my take. I'm pretty super bullish on silver, but until it starts closing and below doing new lows, that's the play to be there right now.
Fantastic. Now to kind of open it up to open discussion, if anybody would like to chime in, one of the things I'd really like to do is kind of take a step back and kind of reflect on the data we just got out recently about the CPI. 2.5 years, the highest inflation rate we've seen in 2.5 years. So what is everyone's perspective on this increasing inflation rate that we're seeing?
I'd like to just say, listening to everyone, it was you guys are all very smart and all make wonderful points. Two things that stuck out to me, Craig, I wonder if the people who are professional traders who look at the real rate of inflation, that look at that in relation to bond prices, really believe the CPI numbers, really believe that we're only running, 2% inflation or now 2.5%. You know, we did an interview with John Williams the other day and said, you know, he said it's running at 9% if we use the real metrics. And yeah, there are a lot of things breaking out like lumber and beef and what have you. But I guess just for me, I stop and I think, how do the people that are professional traders really look at those numbers and believe it? And one other point, and then I'll let whoever wants to reply. In listening to what Jerry had to say, I think that might be the most important take of the evening. And I mean that in the respect that I've been talking a lot about the Chinese Belt Road and Rail Initiative. It's the largest infrastructure project in human history that's connecting 70% of the global population, 45% of GDP globally, with nearly all of the contracts settling in this new Chinese digital yuan. And so, you know, you're indoctrinating 3/4 of the world nearly into a challenging or competing, ultimately perhaps competing world reserve currency, or a currency that will challenge the dollar anyway for singular status. And the U.S. isn't part of this. So I think what Jerry had to say was fantastic. But Craig, I just want to ask you, do you really believe that the people who base their movements on real rates of inflation truly believe the numbers that the Bureau of Labor Statistics are telling us are real?
When I've been asked that, I always say it doesn't really matter what the retail traders might think, because, I mean, we're all pretty small cogs in the machine. Speaking of machines, if machines are going to trade futures, and that's probably 90% of the volume now is HFT pre-programmed algos, they are programmed, at least as I understand it, to look at and measure real rates as that annualized CPI versus the 10-year. So we can all talk about the Chapwood Index. We can talk about the report I saw in the NBC Nightly News tonight about food prices, and we all know it's bogus, and we know why they did it 30 years ago, right? I mean, Alan Greenspan went before Congress and told them they had to do a reconstruction of the CPI, because if they didn't, the cost of living adjustments on Social Security alone would have the average Social Security check by now at $6,000 a month instead of $2,000. So this is all done for a reason. Or even calculating real GDP. If you had inflation at 6%, you'd be negative real GDP growth every quarter. Right. So they can't do it. And then you get to the bond market as well. I mean, no one's going to buy a 10-year note at 2% if inflation is recognized to be 8%. So we all know that this is a scam. But in terms of asset allocation and positioning, everybody's using that CPI. So I don't really know how, you know, us or we as retail people, you know, traders, if that really has much impact. And finally, ultimately, I should explain why real interest rates have such a tight correlation with gold prices. And it's because gold as a foundational asset, which is really what it should be of everybody's portfolio. What's gold's competition globally? What's a 10-year treasury note? And the 10-year treasury, U.S. treasury note, is that foundational asset for pension plans and foundations and endowments and hedge funds and the like. And if you're cranking out a real positive real return on your 10-year treasury note, where you're getting 4% nominal interest versus inflation at 2%, this is great, right? But when you turn the 10-year treasury note into a guaranteed loser, even at the CPI level, all of a sudden gold that doesn't pay a dividend, we all know that, right? We get beaten over the head with that. Also has a negative carry cost by the time you insure it and store it and all that kind of stuff. Well, hell's bells. That sure looks pretty good compared to negative 1 or 2% real return. And so that's why those numbers are important. Yeah, you and I and everybody else I see across the screen here, we know the CPI is bogus. But at where the rubber meets the road, if you measure it that way and you crank out a negative real return, that's pretty fundamentally strong for physical gold.
If we could get Gary's perspective on this, because I know, Gary, last time we had you on, you were talking about how, just the whole financial system, there's a problem, and there's a problem with the debt, right? And that's kind of on the same topic that we're discussing, that the dollar could be in trouble, and the United States with such high debt and deficits is in trouble, and that will impact precious metal markets. Can you give us an update on that?
Well, I mean, I think that is the largest core issue that we'll face in the upcoming years, and that's the economic fallout from the massive spending that the government has incurred to get us out of this recession that was caused by a pandemic. It is a new way of thinking, if you look at the multitude of years, to have Keynesian economics, which really began after World War II, where we started spending more than we took in, where we actually went over budget. And we spent $4 trillion last year. Right now, another $2 trillion. Biden is proposing another $2 trillion, but he says he will get that by taxing corporations with more money, and that's going to be a hard sell. But the thing is, the level of debt that we have, along with other countries who are doing the same thing, the currencies are kind of in a race to zero, because anytime you allocate more debt, the value of your currency intrinsically has to be worth less. There's no other way to look at it. And the thought of paying it back with a growing GDP is tough when what we have heard is that in this year, our debt structure will be 1.25% of GDP. That is not sustainable. And so how is that going to all unfold? And that's a question I don't think I can answer, but I think that there will be a major economic fallout from all the expenditures without being able to pay them back. Maybe I'm incorrect. Maybe this is a system that will go on. It's fiat currencies. But I think that at some point, as Barry Commoner used to say, there's no free lunch. The bill will be presented and something will happen. And that will happen years down the road. That's my take.
I'm just wondering because I took a chart of the deficit and the US dollar and they match perfectly. Like you take it from whatever the 50s as the US deficit's been going down and then it's almost leading. So the US deficit now went like, whoa, just down. And you like, it's a crystal ball again. Like the US dollar, unless GDP goes up and compensates, the US dollar is doomed right now. It's on trajectory to zero. And I go on the website Priced in Gold and he has a chart, the half-life of the US dollar since 2001. That chart's like epic. The US dollar had a small reprieve in 2013 until now, but now it's back on track. Every 4 years, it loses half its value. The US deficit now has the rate of change is just down. So that's like, for me, a risk reward in our favor of the precious metals there. You couldn't be at a better situation. And it's just insane. And if there's so much impact of the US deficit on everything, sometimes I'm trying to look at which one's the egg, which one's the chicken. But so it's the Federal Reserve controlling the rates. But I think they're these days, I think they're just reacting to the US deficit. I think that's pretty much like the Rosetta Stone. And every time it does an explosion, you could look at the distance from its, let's say, a 1 year, 2 year moving average of the US deficit. And you could overlay the silver chart, you could overlay the gold chart, and they match perfectly. Gold, silver, commodities, the interest rates, they all match the rate of change in the US deficit. It's like mind-boggling. So, let's see how they get out of that one. But in the 1940s, we had a rate of change almost as bad, not as bad as what we're doing now. But in the 1940s, I don't know what happened in the States, maybe the war or something, but you got out of it. So what's the difference between now and the post-1940s, 50s? But they remember after that, they built up the insane inflation then into the 80s, in the 60s, 70s, 80s, it went crescendo up. So my mind sometimes it goes like gray, like I'm trying to figure that stuff out. What's the next step? And I guess that's why everybody's debating, everybody has a theory. But it's definitely going to be rock and roll there.
When you look at what happened in the 1940s, realize, I believe 1933, 1934, the president put out a order that all Americans had to return all their gold coins and silver coins, as well as silver certificates, notes that let them pay on demand silver, or the $20 currency that was available to go into a bank and trade it for a $20 gold coin. And so when he did that, that's what made the United States the largest gold holder in the entire world, was that we had basically confiscated a vast majority of gold that had private ownership. And so that's why you saw what happened in the 40s, because that was that whole idea of actually backing the dollar with gold. Now, Nixon put really the final nail in the coffin, so to speak, in 73, when he broke the Bretton Woods Agreement, which was that although citizens couldn't redeem certificates for gold, countries could. And once that was gone, that's when we really saw gold begin to move off of. I mean, it was from the 1800s on to the early 1900s sitting at about $20 per ounce of gold. It didn't move. And it had the same buying power as the currency because they were connected. Once that connection changed, you saw it kind of fluctuate, 300, 400. But once Nixon removed that final nail, we really saw that's when gold started taking off for the first time. And I think that's the real difference. That was the move to pure fiat currency.
And remember, too, when we talk about the CPI, as just one of the levers that they use to perpetuate the system. When people talk about the dollar and the dollar being strong or the dollar being weak, it's another tool that they use because what are they talking about? They're talking about the dollar index. What the hell's a dollar index? It just compares a dollar to equally worthless, equally devaluing other global fiat. Yeah. So, if they're all being devalued at the same rate, then relative to each other, they're not changing. And so that's all part of the spin that gets put out there to try to keep the music playing.
And really on that point, Craig, how it seems like, to keep the music playing, right? It seems like these things are going on longer than a lot of us have been expecting. And, like we said at the beginning, a lot of us maybe didn't expect a pullback in the metals after some of the greatest money printing we've ever seen in 2020, right? The most money printing we've ever seen in 2020. And I'd like to turn to Jerry now, kind of to pose this question of one of the things that we've really been not expecting as well is the stock market just continues to rise amid an economy that is struggling, right? It's not in the best spot. And so your perspective on that, your perspective on the stock market, some people have been calling for a crash recently. Your perspective on where we are and where we're going.
I got calls at the beginning of the year from different advisors, analysts, just wanting to know, what our research was showing. We expected the market to continue to moving higher. There was really no downside catalyst that the Fed would not step in immediately and prop up. I think we've created the moral hazard here where there is simply no scenario that an investor in the United States at this point feels as if the Federal Reserve will not step in and prop up the markets. They'll move rates to zero again if they have to. Well, that's kind of where they are now, aren't they? But they've been getting away. So I think the thought has always been that things will finally crash whenever people finally wake up. I think the part of people waking up, is probably the part that's going to take a while. Even as we're moving now to a digital currency here in the United States, eventually we'll have one. The United States is going to continue its debasement of the U.S. dollar there. So, as far as stocks go, they compose 20% of our total investable assets. We've been happy to be there, since the since the 2008 crash, when we called the uptrend. I think it was like in March or April of 2009 with our system. And, it's been pretty much a long-term run that's been Fed fueled. Just because the market is going up doesn't mean the economy is healthy. It doesn't mean that at all. It just means that there's too much money chasing too few goods or too few investments. And that's what we see with Bitcoin, for example. I mean, Bitcoin has been the big beneficiary. People are pointing to the fact that there is rising inflation. Well, we're seeing something that's, that's responding to that. I mean, whenever I wrote my book, Bankruptcy of Our Nation, Elijah, back in 2007, while I was writing it, finally got it out published like in 2009, right when the crash happened. It was so ironic because at that same exact time, at that very time that I was writing that book, and that book was all about the fiat system, the debt-based monetary system, understanding how money is created, the Federal Reserve, I mean, all the central banking stuff, all the history, helping people understand how to break free with, precious metals and diversification in different ways, real estate. Well, whenever I wrote that book, I was writing that book at the same exact time that somebody I don't even know named Satoshi Nakamoto was writing a white paper. We were both talking about the same thing. In my book, I was talking about the fiat monetary system and how it was unsustainable. Satoshi Nakamoto was writing a white paper and creating a process by which value would be transferred in a trustless way, and thereby skirting around the Federal Reserve. This is why you heard recently PayPal's former CEO or founder, Peter Thiel, say that he thought that Bitcoin was a Chinese financial weapon. It's because it is clever in how it sidesteps the dollar. It's not part of the U.S. financial system. And so therefore, because it's finite, it goes up in value if there's a fear of inflation. So many people think that Bitcoin is fool's gold, and it very well may be in the end. We'll all find out, won't we? But for now, I allocate 5% to Bitcoin and many different digital currencies, just as a part of my allocation. And gold and silver, by the way, I want to make sure, that I state this, that, gold and silver I view as insurance. I think they're wonderful to have as a part of your portfolio. Now, will they boom, like we saw in the 1980s or like we saw in 2008? Well, sure. I mean, the gold's already at a new all-time high. Gold's been in a long-term uptrend for a long time. Silver's been in a long-term uptrend since I want to say May. And so we see more upside ahead, but again, we're not, that's not the only basket we're putting our allocation. We have different allocations. And so we have good hopes for gold and silver. The dollar is going down. Gold and silver will inevitably benefit, but it's not the only part of our portfolio, nor do we think that we would get rich, from gold and silver specifically. I think that might be a mistake to put all your eggs in one basket there. I think it's wise to be diversified.
We can actually just move forward here to get anybody's perspective, kind of an update, because I know one of the big things when Biden was first elected for silver was that there was this green energy plan, right? And that there would be a lot of demand for silver. And we've seen a lot of demand for silver, especially on the investment side. But what are all your expectations moving forward as the green energy plan kind of takes life, right? It gets going. What is your expectation for industrial demand coming soon?
It has to be huge. Elijah, we did an interview with Keith Neumeyer. He told us it's coming out of the ground at 8-1 as a ratio globally. Coming out of the ground at 8-1, yet being priced at almost 70-1. And with the expansion in green energy in a digital world, and I go back to the Chinese Belt Road and Rail initiative, which is connecting 70% of human population, not just by roads and bridges, but digitally as well. The fact that it's a depleted asset, the fact that it is being used and accumulated for industrial purposes so voraciously has to play ultimately into the price. I look at it the other way around. It's an awakening of the monetary side that's been sleeping for a long time. The industrial side is increasing and seems to be increasing exponentially at a period of time where it's becoming exponentially harder to find it in nature. So I for one, think it is going to be a major catalyst moving forward.
Actually, a really good point. We talked about GDP growth and where could it come from, and listening to you gentlemen, it was fantastic to listen to. Two thoughts popped in my head: value creation through creating higher value products through the Green Wave initiative, forcing that transition, like Industrial Revolution 3.0, 4.0. Forgot where we're at right now, but that's happening. But also wars. Right, that's a really interesting one, and it's something as I said, I'm on Twitter. I can't pinpoint who posted it, but you see more saber rattling in the Ukraine. You see more saber rattling in Taiwan. Ever since January, that has really been picking up, and that's the other way to justify money printing as well, and flooding the system with money and perhaps increasing GDP by focusing more on that side of the thing. It's going to look different. It's going to be modern technology wars. It's not going to be creating tanks and bombs like we did in the 40s or like it happened in the 40s. But I think that's an interesting aspect that we haven't talked about yet.
Definitely. Could you expand a bit more on how, this green energy initiative is going to impact the mining sector for silver?
I think it's really interesting because silver has so many applications, and now it's a coin flip whether you regard it as a precious metal or an industrial metal, because it uses it so many things. I've seen in Germany, I think I've seen a deodorant that helped silver ions in there for the antibacterial effects as well, and those things are usually not regarded as such. right? So Keith Neumeyer's and others are paving the way there and really making sure that people understand, like, what do we use certain precious or metals for? People don't understand it. I always find it interesting. People are demonstrating for a cleaner world and better energy and taking photos and filming it with their iPhone 12 Pro with the biggest camera they can find on the market. There's so many metals in there. It's moronic almost, right? But it's interesting, and I'm not sure why people don't understand it, like where this is coming from. So this all boasts well, like transitioning. Yes, if we move away from the internal combustion engine, we move to electric. Like, I don't even know what the real numbers are anymore, but I know that they're insane for nickel, for copper. Like that's going to have a huge impact. And storage, we haven't even talked about energy storage yet. That was a big topic in 2015, 2016, and that sort of faded away because Tesla didn't really push forward with home storage. That was supposed to happen at some point. I was looking at that sector back in 2015, 16. So those are a lot of factors, and it's going to have a huge impact. It's going to shift. Maybe gold and silver might not be, or gold might be left behind a little bit in terms of performance, but it's got to be like silver as a precious metal. It's going to be benefiting hugely.
Follow up on that I was curious about. So we're talking a lot about silver when it comes to the space of green energy and industrial application. But I know there are a lot of, green and industrial applications for platinum. And that's one that we haven't really heard about since it's had a spike 6 months ago or whatever. Does anyone have any thoughts on that or more about silver or that kind of thing?
Most of the uses in platinum are in catalytics, and right now it's only in diesel automobiles. It used to be in unleaded, but mostly in diesel. I think that the part of the difference also is that platinum doesn't have the history as a monetary metal. And speaking as the owner of a precious metals company, out of all the sales we did in 2020, which before the first quarter of this year was a record year, I would say that silver represented pretty darn close to 90% of all the sales that we did, in total. And this year it's probably even more. So the demand for silver, at least here in the U.S. from a retail standpoint, is extraordinary, where platinum represents at best 1% or less. So I think platinum has a similar story to silver, but certainly not the myriad of uses that silver offers in industry. And you look at the need for silver in anything that's digital, anything that conducts electricity, anything that is going to be used in a green future. Silver is massively needed. And so while it's a similar argument, I think it just is not quite the same thing that we're seeing in silver on both the monetary side and the industrial side. That's my opinion anyway.
And I might add too, we all know on this panel that silver is mainly a byproduct of other mining base metals. But a lot of folks listening probably don't know that. There are very few primary silver mining companies where all they do is go out and hunt for silver and pull it out of the ground or the mountainside. Most of the silver that comes out every year as mine supply is generated through mining of other minerals. And silver just kind of comes out, and gets grinded up and, look, we got some silver here we can sell. When that makes silver a pretty static physical supply every year. It's about 850 million ounces, sometimes a little more than that. Sometimes it'll be less in 2020 because of COVID, and Mexico and Peru had their mines shut down, things like that. But let's just call it on average 850 million ounces a year. And then you've got, 150 million ounces of recycled silver, grandma's silverware and candlesticks, and stuff like that. So really there's only 1 billion ounces a year, but pretty steadily now for a number of years, industrial demand is about 600 million ounces. And we talk about the Green Initiative and Belt Road and all this other use for, more silver and electronics to replace fossil fuels and the rest. And that industrial demand could go to, 700, 800, 900 million ounces a year. And whatever is left then is investment demand. And as Andy has pointed out, investment demand's through the roof this year. And then pretty soon you're talking about structural supply deficits every single year. Now, some people are out there saying, oh, don't worry, there's 1 billion ounces here and 1 billion ounces there. And that can always get tapped into it. One, I don't know if that's true. And then second, that kind of assumes that the people that have that 1 billion ounces will be happy to part with it. So there is a pretty compelling physical demand component that meets up with that supply. And if you grow the industrial demand at the same time we're growing investment demand, that makes, it's like anything else. That's why I bought Bitcoin in the first place, because I finally figured out this halving thing. And I thought, wait a second. So demand's going to increase and supply is going to get less. That sounds like, I mean, I don't remember much from college, but I remember learning that probably means higher prices. So maybe in the end, you know, the physical fundamentals and the demand fundamentals will finally hold sway and push prices higher too.
It's a perfect storm. I hear you guys. Look, all the fundamentals. It's like, I try not to make abstract of that, but like just for like the supply side, all the miners, like Tavi Costa put out a chart of investment, capital investiture in minings, and since like the 1980s, and it's just been going down like that.
Yeah.
And then you overlay that with the Fed fund rate. It's the same chart. It's like, I think Peter Schiff kept saying that it's like the higher the interest rates, the more people are going to invest their money, their savings into capital investiture. So right now, nobody has been looking at the miners. There's not a lot of pure silver plays. Everything's rock bottom. All the scenario buying cheap in all the charts right now. You can get lower than that, and you get perfect timing because silver did explode off July in 2020 when it got off above 1820. So just timing wise, like I know fundamental guys, sometimes if you keep saying it's going to go to the moon, but you want to get the timing right. But now the technical analysis on monthly charts, quarterly charts, telling you that we're not that far away, man, for a continuing up move there. It's very impressive.
And it'll definitely be very exciting to continue to cover this and see, you know, where precious metals are going. And we can definitely be surprised as we have been in this quarter, but who knows? You know, it seems like if we look at the fundamentals, it seems like we're headed higher. So I really wanted to say thank you to everyone who joined us today. If people would like to hear more of these Mugs and Metals, more of these interviews, hit the subscribe button and the bell icon. And if you're really intrigued by all the great people and the reporters in the precious metal space who have joined us today, we'll put the links to all their websites in the description of this video so you can check them out as well. But before we let everyone go, how'd you like your drink today? Mine was a local IPA. It was Four Peaks Brewing Company. Four Peaks is one of the old volcanoes near where I live in Phoenix, Arizona. So it was quite good, quite smooth, pretty light beer, but it was good. So anybody else, what did you think of your drink?
Good way to spend an evening. Appreciate it, fellas.
Delicious.
Thank you very much for the invite. And yeah, I'm drinking seltzer. It's really nice. It's been fun.
Nice. I think I'm going to finish that one off tonight. So yeah, that was worth it. Much appreciated, Elijah.